thank everyone for being on today. Again, this is Charlie Castro with REO Reseller. I want to thank you all for being on this morning's webinar. I'll be going alone today. We're going to take questions at the conclusion of today's webinar. So if you have any questions, if you look to the right of your screen, there's a chat box, or actually there's a dashboard there. And then down below there is a little button that says questions. If you just click on that button, you can answer your questions, and I'll take those questions at the conclusion of today's webinar. We are recording today's webinar. We've been asked from a number of people to record this one, so folks that couldn't show up, so we are recording it. So if you want a copy of it, just contact me, and I'll be glad to send you a copy of today's webinar. So again, I want to thanks to we're going to talk about a number of things today to advertise this as being. We'll talk about top 10 reasons to buy and hold real estate in 2014. I borrowed from Corsini, who's a known real estate analyst, writes a number of blogs, writes for a couple of different real estate publications. So I borrowed his top 10 reasons. We're going to go over that. We're going to talk about some other things as well. We're going to talk about where the market's been in 2013, what some of the market trends we're seeing for 2015. What are the big hedge fund guys doing? I've had a number of conversations in the last couple of weeks with some of these institutional buyers, just sort of picking their brain and talking to them about what they see in 2014 and beyond. Interestingly, most of these folks still see this as a long-term business. They don't see this as a short-term business. I actually was asked to sign a fairly lengthy confidentiality agreement with a large hedge fund just last week. I said, "Why am I doing this?" I said, "Are you just, this essentially saying that you guys have long-term aspirations in this, and you want certain information that I share with you to be proprietary?" And they said, "Well, yeah, we see this as still a 5-year play," and that's an interesting statement. We'll talk some about today. We'll talk about what some of the larger hedge funds are doing, Blackstone, Warren Buffett, and so on. We'll talk about those top 10 reasons to buy and hold real estate. We're going to spotlight Birmingham, Alabama today as a market. We are in Birmingham. Most of you know that we operate down there. Some of you don't know that we've now spread out. We're in a number of different markets now. I'll talk about that a little bit, talk about keys to buy. I'll just show a couple of different examples of available real estate. The latest Standard & Poor's Case-Shiller 20-city home price index came out the end of October. This is the most recent one. I'm going to go over a few statistics. I've shared for the last couple weeks. I've been doing just just webinars on current state of the real estate market. I spent a lot of time doing research into what's going on in the various markets around the country. These numbers are pretty consistent across the board. 12.5% is what we saw in 2013 in terms of appreciation in the home values across the country. 20-city home Case-Shiller saw about the same thing. You did see markets like Vegas that did go up 29%. But the thing I'm going to focus on, this is what all the analysts are saying, still 47% lower what they were before the housing market collapsed. A lot of folks think now, wow, the market's come back. I must have missed my chance. I don't believe that at all. Clearly, the larger institutional buyers don't believe that at all. We did see some 20-plus price jumps in some markets, Denver, Dallas, Flint, Michigan, Phoenix, Las Vegas. All those markets were up quite a bit. But interestingly, they're not back to mid-2004 levels. They're still 22% in most markets below the previous peak, and in some cases even lower than that. So while markets gain traction, we're still not close to where it was. And of course, I'll go over some charts and some graphs later and show you what some of these institutional buyers sort of look at. I pulled this off CNN Money back in July, just talking about the long national foreclosure nightmare coming to an end. In June, we had the lowest amount of foreclosure filings filed since December of 2006. It was a 35% decrease from the previous year, 127,000. Still a staggering amount of foreclosures, no question about that, but it's 35% lower than the previous 12 months, and their lowest level since December of 2006. Short sales, I highlight this because this is really interesting. Many of you recall, if you go back 2, 3, 4 years ago, short sales were kind of the easy way for banks to liquidate inventory. It was very common for a realtor to literally write an offer up on a property on the trunk of their car and send it to the bank. Hey, here's an offer. It's a short sale. We can get it off your books quickly. Short sales are down dramatically. Most sales now, 44% of all sales are made by cash. Interestingly, now what does that tell you? It tells you a couple things. First of all, the large institutional buyers, the total number in 2013 was $9 billion they invested in single-family homes. That's all cash. None of that money was financed. It was all done in cash. The other part of it is you have smaller investors, individuals, onesie, twosie, threesie. You see more and more now people, and I'll talk about that when we get into the top 10 reasons, but you see more and more people now using real estate as a way to build retirement portfolio. So you see all these cash sales. But in some of these states, you look at the bottom paragraph, Florida, 65% of all sales completed was cash. Nevada, 55, Georgia, 55, South Carolina, Michigan, Ohio. Huge numbers. And what that just essentially is, investors, whether they're large or small or somewhere in the middle, that's buying the bulk of real estate today. And the reason why banks are shying away now from short sales. I love this cartoon. I pulled actually my son pulled this off. I love the cartoon because it kind of sums it up. Hedge funds, guys that specialize in highly complex derivatives, exotic financial instruments for that discriminating investor, and he says buy gold. Yeah, it's just really that simple. I mean, real estate is just seen now by all these larger buyers as being the safest place to put your money. And they'll all tell you a little bit of a different reason as to why, but it's all essentially the same reason that we're going to go over in the top 10 reasons why you should buy and hold real estate. Their models are really identical to what we're going to talk about. They believe that it's the safest place for your money for a lot of reasons, including that fear thing that's out there, the fiscal cliffs that we've faced, the closing down of our government for political purposes. And all those sorts of things play into, the fear that the other shoe going to drop. We carry this massive debt. So where's the place to have your money? Well, you can buy real estate right, and that's what we're going to talk about. If you can buy it right, have the infrastructure to manage it properly, then clearly real estate's the best place to be. And so that's what guys have invested money. So I'm just going to talk about three, and if for those of you, and I see a lot of names that have been on the ones in the last couple of weeks, our webinars last couple of weeks, I'm not going to spend as much time talking about this today in detail like I have been. I'm just going to sort of capsulize it. There's really three that I've highlighted. Blackstone, if you don't know who they are the largest owner of family homes in America today. They have a $13.3 billion real estate fund. It's the largest opportunistic property fund ever raised, $9 billion invested in 31,000 homes in 13 markets across the United States. Yes, they are in our markets. I'll talk about our markets in a little bit. They are in those markets. Warren Buffett, if you don't know, kind of also with him 2 years ago when they asked him on CNBC, is buying real estate a good idea? And he said, I think it's a great idea. I'd buy millions of single-family homes if it were practical, but that I'm not very handy. And what he was saying was that, yeah, it's a great, buying real estate makes great sense. The market's down. You can buy the real estate cheaper. There's certainly margins there. When you walk in the door, there's appreciation to be earned. There's cash-on-cash monies to be earned. But how do you do it? How do you have the infrastructure? How do you find the homes? How do you manage the homes? How do you fix them up? All those things that goes into finding success in the real estate market. How do you do it? Well, what Warren Buffett did, being Warren Buffett, of course, he then went out and purchased Prudential Real Estate. They've rebranded that name under, I think it's Berkshire Hathaway Home Services is what it's now called, but it's Prudential Real Estate. I believe they'll probably still fly under that flag in 2014. There's a brand recognition there with Prudential. But that's owned by Warren Buffett. So what is Warren Buffett doing? He's out buying real estate. He's got teams of people, no different than Blackstone or anybody else. They're out there searching for inventory, properties to buy, people to help them fix them up. That's what they do. John Paulson, the last person that we profiled this past month, if you don't know who John Paulson is, he's the guy that accurately predicted the foreclosure meltdown back in 2006 or 7, I believe. He bet heavily against the market, made lots and lots of millions of dollars doing that. He is very active in the market today. I've been using one of his quotes for several months now, saying that it's still a great time to buy real estate. It's certainly too late. Affordability still at an all-time high. All three of these funds go into 2014 with the same exact strategy they had in 2012 and 2013, and that is to buy and hold real estate. That is their model, is buying and holding. Now, there's nothing wrong with the flips. Many of you know, and I see a couple names on today's webinar that have been involved in some of our flips in 2013. Nothing wrong with a good flip. You can get a good flip, and you can get in and out in 90 days, $4,000 or $5,000 on a $30,000 or $40,000 investment. There's nothing wrong with a flip. But the hedge fund buyers all see this as a long-term play, and this is Jonathan Gray being quoted here. Jonathan Gray is the head of, by the way, he's the head of Blackstone Real Estate. He's 43 years old. In 2010, Jonathan Gray became a billionaire. Yes, indeed, a billionaire. I think he took something like $122 million in bonuses from Blackstone in 2018. So this is Jonathan Gray saying the market should remain bullish for 2 to 4 more years. That's what I've heard the last 2 weeks. 3 to 5 year plus long-term business. There is an exit strategy at some point. We'll talk about that. But most of these guys still see this as being a market for 2 to 4 more years. What's their strategy? Well, their strategy is buy and hold. isolate key markets for growth, renovate the properties, invest no more than 10%. What does that mean? It means you don't buy properties that takes a massive rehab. If you get a property that needs a new roof, new electrical, new plumbing, new foundation, you probably shouldn't buy that property. The biggest mistake that people make when they buy into real estate is they don't buy with enough equity walking in the door. That's mistake number one. And mistake number two is they undervalue the cost of the rehab work. In other words, they buy something for 50, let's say. They think they can rehab it for 25. It's worth 100. So they're thinking they're going to be all in at 75 and flip it for 100. Not a bad model. But then they discover that the rehab cost is really $40,000, and all of a sudden they're going to value their property at more than it's been. I've seen it happen over and over again. I know lots of folks that attended my webinars the last couple of years that have called me up and said, you know, I partnered up with a flip, some people in 2012, and I can't sell it. And the model's always the same. They didn't buy in with enough equity, number one, and number two, they undervalued the cost of the rehab. So 10% is all you want to be investing in that property in terms of rehab. What does that essentially mean? Carpet, paint, flooring, that sort of thing. Their houses have a 94% occupancy rate. It's the best rental market we've been involved in the United States in quite a number of years, and they still see it as a long-term business. Pretty consistent across the board, and of course I get asked all the time, you know, is 2014 the right time to buy? You know, prices were high. I've been looking. I mean, I sincerely have clients that have been kicking these tires for, well, I've got one gentleman in New York City who's been kicking the tires for 2 years now. He'll ask me, am I too late? No, you're not too late. There will come a point when you're too late, and there's certainly markets that you're too late to get into. I live in Southern California. I've talked about that. I live in Orange County. It's one of the higher real estate markets in the United States. They consider it now to be the most overinflated real estate market in the United States. I'm not sure that's a good thing or a bad thing for me, but anyway, it's a nice part of the world. I wouldn't invest here as an investment. I certainly buy here. I love to live here. The schools are wonderful, my kids, but would I buy here as an investment? Probably not. Would I buy in Vegas as an investment? Probably not. Phoenix? Probably not. But there's a lot of markets that are still right, and we'll talk about some of those today. Okay, so the top 10 reasons to buy and hold real estate. Again, I got this from Ken Corsini. If you just Google Ken, you'll see his accreditations. He writes for a number of different publications. So, top 10 reasons. The number one reason is appreciation. Without any question about it, you want to look for markets that are going to cycle up. Markets where values rise quickly or fall quickly, but by and large, the real estate's an asset class that appreciates. You want to be in a property in a market that you know is going up, and there's lots of indicators for that. I try to share those with our clients, whether it be a webinar or whether I finally get in front of somebody and they say, well, these are my goals. Where do I want to be at? You want to make sure you're in a market where the market's going up. You want to get some cash on cash too, but appreciation is still the number one reason. Second reason is passive income. We call it mailbox money. You just go out to your mailbox every month. You got a check in there, and there's your return. If you're getting cash on cash return, and you're getting in a market where you're getting appreciation, you're getting a double dip, so you're really getting some pretty strong numbers. And I'll go over numbers specifically as I get towards the end of my presentation. But passive income is the second reason, and that, again, this is one of the reasons why institutional buyers love this business. Is it isn't like they have to wait for a return. They don't have to go to their investors and say, you'll begin to see a return on your investment in approximately 90 days or 120 days or 6 months. That's not uncommon in the investment world, by the way. So having something that gives you passive income out of the gate is extremely attractive. Number three, it's high leverage. It's certainly you're going to leverage against inflation. There's lots of the example they use here is actually pretty powerful. If you go into your bank, you try asking for a line of credit for $800,000, you're going to secure that with $200,000, and you're going to invest that in gold and stocks or mutual funds, something along those lines. You're not going to get that loan. The banks just aren't going to loan for that. But if you go to the same bank and you say, I want to buy 10 houses at $100,000 a piece, they'd be sitting you down saying, let's fill out the application. If you've got the cash collateral for that, the down payment, you can do that. The bank will partner. Now, why would the bank do that? Obviously, it's a piece of real estate, and they understand that. There's a high leverage there with real estate. Number four is high ROI, and I'm going to talk about ROIs when we get there, but I'm going to give you some flavors of just what ROIs look like. I believe that if you're not getting at least 10 to 12% cash-on-cash rate of return, regardless of the market, that you shouldn't be in that market. Now, Southern California, I get asked all the time, hey, Charlie, I'd really like to invest in Southern California. I live here. I'm comfortable knowing it's down the street. I think that's grand. But understand that your rate of return in this market is going to be lower. It's going to be 5, 6, 7%. Give you an example. 2 years ago, well, that's not true. A year ago even, I was still working heavily in the Atlanta market. Still do. Still have inventory in Atlanta. Housing prices are higher there. Rates of return now are 6, 7, 8%. If you get to 9 or even 10% in Atlanta, that's a smoking deal, and you can hardly find those deals anymore. Now, other markets, you can be in the 10, 12, 13, 14 percentile. Now, I can even tell you that we are in other markets right now, like Detroit. I've got a small package in Toledo, Ohio, where you can get homes for as little as $20,000 a house. Those homes are cash flowing at 20%, or darn near 18, 19, 20%. So it depends on the market, but ROIs is one of the top reasons you want to buy. But to me, you want to look for over 10%. If you're not getting 10% cash and cash in your money, I probably would look at a different market. Number 5 is principal paydown. Now, this isn't applicable to most of you because all of you are going to be cash buyers. But what this is basically saying is that if you're getting a loan, or let's say you're partnering up with a friend, which is not uncommon. We've done a number of deals where a friend or family had gotten together and pooled their money and bought a couple pieces of property for cash flow and appreciation, and then with the idea of selling it down the road at a nice profit and the yada yada. But if you're financing it, essentially your tenant is paying off your principal for you. So the tenant's paying your loan, you're paying down the principal. At some point in time, you're going to sell, and you're going to make some profit on your investment, and it's all good. And people ask all the time, well, what about getting a non-recourse loan? And I say, well, fees are prohibitive. I'm not a fan of non-recourse loans. I won't recommend somebody get a non-recourse loan. But then other folks will say, well, so what? So I'm paying a lot of my cash flow out in fees, but I'm getting the appreciation. Okay, all right, I can dig that. If that makes sense to you, that you want to leverage the property against a loan, and you just look at the appreciation long term. Yeah, okay. But principal paydown is a very attractive part. Now, tax benefits. There are a bunch of tax benefits, and I actually studied this at the end of last year. I'm actually going to do my next webinar probably the first week of February. It's going to be the top 10 tax benefits to buy and hold real estate. Now, disclaimer, I'm not a tax accountant. I'm not a financial planner. I don't have a license to give advice on the tax benefits. So what I'm going to do, I'm going to read off of a publication that listed the top 10 tax reasons that I found to be the most compelling. These are tax professionals. I'm going to read from that, and then I'm going to have a financial planner on the phone on the webinar as well that can answer questions, because I am not qualified to answer those questions, but I can read. And in reading, I've learned that there are lots of tax benefits. Anybody that's on this webinar who has purchased or is about to purchase, I would encourage you to learn what those are, because there are things that I didn't even realize. And I'll just quote one, for example. I didn't realize, for example, that if you own a buy and hold property and you have to replace the water heater, that cost is tax deductible. I did not know that. So there are tremendous tax benefits to owning buy and hold real estate. It's certainly a hedge against inflation. Inflation is something that we are going to see eventually, and we're starting to see a little bit of it now, but to think that we are not going to see inflation again at some point in time would be ill-advised. We are going to see inflation again, and it's certainly a hedge against inflation. As prices go up, so does the value of your property. So God bless. You got a piece of property, you buy it at 50, the inflation kicks in, all of a sudden stuff starts to inflate in value, and all of a sudden you're locked in because you bought it for cash. You don't have a loan attached to it, so you don't have to worry about your variable mortgage going up or something as inflation rises. So hedge against inflation is a powerful, powerful reason. And then the other one is increasing rents. And by the way, those two sort of go hand in hand to me, because you hear the hedge fund managers and the buyers, and I deal with a lot of those buyers. They'll talk about that. That's two of the inflation. The values are going to go up. Rents are going to continue to go up. Most analysts will tell you that this is the best rental market we've ever seen in this country. So rents are going to go up. So what's that mean? You buy it at a price. Say you buy. I'm just using 50 as an example, but you buy it at $50,000. The value of the home's going to go up. The value of the rents are going to go up. Inflation could cause it all to continue to go up. And you bought it at one price that's never going to move. That price is $50,000. You're not going to be affected by inflation or anything. It's going to happen to that investment. It's going to go up in value. Number 9 is retirement income. And I see this now more than anything else, is people looking to build for their retirement and using the real estate as the vehicle to do it. Most folks see it as a safer way to go than the market or anything else you can invest in today, and that just doesn't go for the smaller, onesie-twosie type buyer. This is what the hedge funds, these real estate investment trusts, this is what these folks see with regards to value in real estate. It's a long-term, certainly not for them, it's not a retirement play. Jonathan Gray from Blackstone doesn't need this for a retirement play. He's fine. But for their investors, they see this as the safest place to have their money short and long-term. So when I see this all the time now, people saying, I got money in the stock market, I want to get out of it, I've made some good money there, and they certainly have, the market's gone gangbusters. It's certainly a great strategy to look to invest some of that portfolio into a retirement strategy. And of course, again, I'm not a financial planner, so I wouldn't be the guy to talk to about it. I do know people I can refer to you, though, but I would tell you that is becoming more and more a common theme for investors. Then at the end, number 10 is creative exits. There is no better time in the real estate market, and I think this will be consistent for the next 5 years. There is so many ways for you to exit, and we get asked all the time, whether it's a buy and flip or whether it's a buy and hold. What's my exposure? What's my risk? I mean, everybody wants to know, what's my risk? And the risk is that you get a house that you've got to either rent for a while because you're not going to get the price you want. You'll never not be able to sell it, by the way. There's too many buyers out there. You can sell anything, anytime, to anybody that's in the market today. I mean, if you send me a house today and say, get me an offer, I probably could have you an offer on the property by tomorrow or the next day. That's not the issue. The issue is, can you sell it for what you want to sell it for? And that's the question. That's where buying right comes into play. But here's the reality of it. Whether you put a for sale sign in the front yard, whether you sell it to an institutional buyer, whether you sell it through webinars like this one or through others that do exactly what we do, we call ourselves independent acquisition specialists. That's a very fancy name that essentially says we help people find buyers for their properties. I'm not a licensed real estate agent. I just refer people to people that have inventory, and if there's a fit, they make an acquisition. So there's all kinds of ways to get out. You can take the old-fashioned route, list it with a realtor, put a for sale sign in the front yard, sell it to an owner-occupant. You can take it to a hedge fund buyer. You can take it to any one of a number of different avenues and channels that you can exit with, through just liquidating through. There's lots of companies that just put inventory on websites and just put all kinds of inventory up on websites. That's not uncommon. So there's all kinds of exit strategies. And one thing I say to everybody is that regardless of what you do, you own the property. So it's up to you what you do with it and when you do that with it. In other words, you can sell it whenever you want. If you buy it today and you want to sell it next week, you can sell it next week. If you buy it today and say, I'm going to hold this for a little while, I think my better strategy is to hold this property for a little while, then do that. That's a better strategy for you. But being able to exit now is no longer an issue. There's plenty of buyers in the marketplace. Okay, I'm going to spotlight Birmingham. Many of you know that we are in the Birmingham, Alabama market. What you probably don't know is that in the last 2 weeks we have contracted homes in Toledo, Ohio. We have contracted homes in Atlanta, Georgia, Kansas City, Missouri, Birmingham, Alabama, and I'm missing one. I can't remember which one it is. Thank you, Matt. Detroit, Michigan. So there's other markets out there now. We're no longer just focused on just one market. We have to look at other markets, and the reason is just really simple. We want to make sure that we continue to provide a product that provides an ROI with appreciation as well. So we just keep looking at other markets. I will also tell you that, and this is a new announcement, that I learned this morning that we have taken a trip down to our wholesalers to Mobile, Alabama. There's some things going on in the economy down there that they're predicting that real estate there in the next 2 years could really just boom, literally boom. I mean, talking about 50% appreciation in homes over a short period of time, and I won't bore you with the details. But the type of properties that we looked at down there, apparently they're higher price. They're in the more of the $50,000 to $75,000 range, but the values are extremely strong. In some cases, 50% higher than what they're being bought at. They're worth, and they expect that to go up even more in the next 2 years. So I won't talk about that. Let's talk about Birmingham. CNN Money calls it the 10th best overall real estate market in the country, the 3rd fastest growing real estate market in the nation. And New Wire Investor, a publication I follow pretty consistently, calls Birmingham the 3rd best real estate market in the country for cash flow. Now we'll go into some examples here in a few minutes. By the way, Rochester, New York is the #1 cash flow market in the United States. And I actually, if anybody has a thirst for Rochester, I have one property in Rochester, New York at the moment. But that is considered the #1 cash flow market in the country. What does that mean? Typically, you're talking about 14 to 18%. That's not to say you can't hit some of those 20s. Those are anomalies, but you can get to that point. But Rochester's #1. Birmingham, Alabama is considered the 3rd best cash flow market in the nation. A lot of that has to do with the revitalization of downtown. I've talked about this over the last 12 months. REO Reseller has been in Birmingham for a number of years, had some really good success down there. The construction site that I'm showing you to the right of the screen, as I've mentioned, is right downtown Birmingham. There's been $1 billion invested in the revitalization of the downtown district in Birmingham, and that's the after picture. That's what it looks like today. That's the new ballpark there. That's the home of the Birmingham Barons. That's right downtown Birmingham. You can see from the photo of the baseball field. It's right downtown. So what has that done? It's just raised the value of the entire market down there. The restaurants, clubs, nightclubs, bars, all the things that are going on downtown. It's a bustling little community now. This I took off a Time magazine about 3 months ago. It was the 50th anniversary of the birth of the Civil Rights Movement, which began in Birmingham, Alabama in 1963. And I pulled this out of Time magazine, and just a couple quotes here that were kind of interesting about Birmingham. The movie 42, the Jackie Robinson film, was filmed in Birmingham. Mercedes-Benz and Honda have opened up plants down in Birmingham. The Better Business Bureau says they've had more money invested in Birmingham in 2012, than at any time in their history. They say it's the second highest market in the nation for building personal net worth, and that says a lot about the economy. And most of you that know enough about our economy know that we're essentially a service economy. Where our economy is very strongly based on people going to the movie theaters and going to the baseball game and going to the local restaurants and using the dry cleaner and the car wash and those sorts of things. That's what makes our economy churn. And when the economy's bad, those things are some of the first things to suffer. I know that. I owned a restaurant during when the markets crashed in 2009 and 10, so I know what that's like. But those are the markets that are initially affected. Are those types of establishments in Birmingham, second in the nation for building personal net worth. So they essentially have disposable income. So that's a good, strong indicator of the economy right there. As I said, they've invested $1 billion to revitalize the downtown area into our mixed-use entertainment district. The University of Alabama at Birmingham, heavy into biotechnology and medical research. And people ask us all the time, why do you? I mentioned I've rattled off a bunch of markets. I'll rattle them off again. Kansas City, Missouri, Birmingham, Alabama, Mobile, Alabama, Detroit and Flint, Michigan, Toledo, Ohio. Those are all smaller markets. So why do we do that? We do it for the same reason that the hedge funds do it. The map there with the blue dots indicates the propensity of where foreclosures hit the United States in 2008. And you can see a lot of that's the Rust Belt. You look at Michigan, Ohio, Indiana. Those states got just ravaged by foreclosed properties. And in some places, like in Flint, Michigan, Flint and Detroit, by the way, were up into the 20 percentiles in 2013. Now, there was a lot of reasons for that. Part of that was the fact that they had a triple whammy there. I mean, they had not only had the economy that took a downturn, but then they had the housing market take a crash, and then they had the automobile industry take a crash, and it all happened about the same time. So the values certainly went down. They've climbed way back up. You can get cap rates in Flint and Detroit now of 20% and buy homes there for $30,000, $35,000. Nice little cash flow properties in a market that's going to continue to go up. But we focus there for the same reason that hedge funds do. It's just simple math. If you buy in what we call the diamond states, which is California, Nevada, Arizona, Texas, and Florida, those are considered the diamond states. If you buy in those states, you can invest $500,000 in those states, and in most of those areas, that's going to get you one or maybe 1.5 homes. And that's going to give you a cash flow or a cap of 6, 8, 9% in a market that we believe is overinflated and frankly can be considered to be a bubble state. It's going to give you a 6 to 8% rate of return on your cash. That same $500,000 in some of those other states, the southern states, southeastern states, the Rust Belt states, your money there gets you 10 times that. $50,000. I mean, in markets like Toledo and Kansas City, in Detroit and Flint, you can get $20,000, $30,000, $40,000 homes there that are cash flowing 15 to 20%. They're just in markets that are continuing to go up, and that are still way below market value. Now Birmingham's a little more expensive, but it's even in Birmingham, $50,000. Well, $500,000 in Birmingham buy you 10 homes. You'd be netting out, $6,000 a month in rent. You'd be getting 12, 13% on your money. You've had your investments spread out, so you'd have some diverse portfolio and more cash flow. That's why we focus on those markets. That's why the hedge funds focus on those markets. I'm just going to continue on Birmingham just for one sec for those that are curious. I see a couple names that are on the call that did buy this past year. I don't recall whether they were buying, hold, or flips, but either way, this is what Birmingham did. I've been showing this site for a while. We knew in 2012 to 2013 it went up 17%. Didn't know 12 to 13. We saw some tremendous appreciation there last year. You can see the green bars, by the way, indicate house prices. The yellow line represents inventory available. And I want you just to focus your attention on just two things. If you look in 06 and 07, that's when the market peaked, right? That's where it peaked out. If you remember the previous slides, Warren Buffett, John Paulson, Jonathan Gray talking about, yeah, the market's come back, but we're still way below the average. This is what they look at. These are the indicators they look at. In Birmingham, you're seeing where it hit bottom 2011, and then it starts its gradual climb back. Where we're at in 2013, and look at where the previous peak was, it's still way below the previous peak. Those are the indicators that these guys look at. And these are the indicators I would encourage you to look at. Look where the market was and where the market is today, and that kind of gives you an idea of where it's going to eventually go back to. So for those that invested in Birmingham in 2013, how did it do? This is off Trulia. I put it off right at the end of the year. This is right up through December the 4th. So here's how Birmingham ended up in 2013. The median sales price homes in Birmingham for September of 2013 through December of 2013 was 181,000. That's a decline of 5.9%, or went down $11,000. Now, why did it dip from September to December? Yeah, probably had something to do with the government shutting itself down. We knew that was going to affect the economy. Everyone talked about it's going to have an effect on the economy. If you look at every market across the country, every market saw a decline from September to December because in November, the government shut itself down and everybody sort of freaked out a little bit. So we saw a decline. But having said that, it still went up 14.2% from the last year. So if we don't have that shutdown, we said all year long we thought Birmingham would do 12 to 17%, depending upon pocket. That's what we thought it would do. It would have done better than that had we not had that little hiccup. But it still saw a tremendous increase, 14.2%, and sales prices have appreciated 57% over the last 5 years. Average price per square foot in Birmingham, highlighted in the red down below, was $93, an increase of 12% compared to the same period last year. And so we've seen increases in Birmingham. If I was going to predict, and I don't have a crystal ball, but I would say based on current market trends, I think Birmingham and the fact that you still have all these hedge fund guys in that market, it's reasonable to expect that you're still going to continue to see in 2014, appreciations of, I don't know, 10, 11, 12, 13, 14, 15. I mean, you just don't know. There's so many, so many things that can affect the housing market. I'm not going to make predictions or rub a crystal ball, but based upon market trends, I think it's reasonable to believe that you continue to see appreciation in the Birmingham market. Keys to buying in today's real estate market. I'm almost finished, and we'll take some questions. Here's the keys to buying in today's real estate market. This is what I see going into 2014. Number one, most importantly, buy below market value. You've got to buy something that's below market value, that's got appreciation when you walk in the front door. It hedges your bet against anything going wrong in the economy. If the market takes a dip, if something occurs some terrible event occurs in the economy, if you've got equity in it when you go into it, you're still not going to lose. So buying below market value is number one. Number two, don't buy anything that's not off market. I see too much inventory now around the country. It's all off market. It's all owned by individuals who buy it for the intention of flipping it to another investor. If you buy something that's on the market, you're going to buy at market rate. I wouldn't encourage you to do that. Buy it off market through a wholesaler. If you don't like me, I can refer you to somebody else, but buy it through somebody that's a wholesaler, not selling something retail. Number three, look for both year-on-year cash-on-cash returns, and appreciation both. If you buy it, just as an example, if you want to buy in Atlanta, Atlanta's a great market. It's got great appreciation in Atlanta. The market in Atlanta is wonderful. The economy there is strong. It's diverse. Lots of good reasons to buy in Atlanta. But you're going to get a 6, 7, 8% cap rate. And depending upon the market, you may get 10, 12, 15% appreciation. Others, you may only get 6, 7, 8% appreciation. If you buy in a place like any of the markets I just mentioned, you're looking at 12 to 20% cash on cash, plus another 10 to 15, 20% or whatever the market appreciates. You're talking about seriously 20+% on your money over a period of a year or so, or whatever, however long you decide to stay in. So look for both cash on cash and I think a blend of both is the perfect world. I had a lady from Las Vegas who contacted us, one of our associates last week, and said, I want to buy in the Vegas market. And I said, hallelujah, I'll be glad to help you, but man, just don't expect to get something that's going to be a high ROI and a great appreciation. Okay, have infrastructure in place. Make sure you know who your property teams are. Make sure you can rely upon people to, rattle doors if something doesn't go the way you'd like it to go. So management's the key. Number 5, understand what your goals are. Am I in the short term, long term? Am I a fix and flip? There's nothing wrong with buys and flips. But understand what your strategy is before you go into it. And then last, Buy below market value. It's the most important piece. So buy and hold strategy. This is the hedge fund strategy. I said here purchase as low as 33.9. I mean, really, I've got some stuff in Toledo. If there's somebody on the webinar that is looking for something, you've only got 25 or whatever thousand. I've got some stuff in Toledo that's as low as 20,000. It's got some really high ROIs. That's an anomaly. I don't get those all the time. That's really super rare. It was actually a gentleman that's in the ministry down there that owns 13 homes and he's old and he just wants to get out. He's tired. He made his money back years ago. He just wants to liquidate. So it's inexpensive entry price, but generally 33 is about the floor. Don't go up to anything past 99. We don't focus on high-end buys or flips. Look for stuff with a 1-year home warranty. Make sure you've got a property management team in place. Make sure the house is fully rehabbed when you buy it. Don't buy something that you have to rehab because that's when problems come in. Make sure it's all in. My price is all in. Make sure the valuations are below market value when you walk in the door, and it's mailbox money. That's what a hedge fund manager is looking for, is just mailbox money, cash flowing rental real estate vehicles. A couple examples just real quick, and then we'll take some questions. This is just an example. This is a $59,000 home built in '78, 3-bedroom, 2-bath, been lowered down to $49,900, and you can see the valuations. Truly has got it at 51. The average price sold for this home is 60. E-appraisal said it's worth 77. If you bring that down to $49,900, your cash flow is about 14%. So here's what I was talking about. You got a 14% ROI. You've got a night in a market that's going to appreciate, and you're buying it below what it's worth. Another example here, a little bigger one. This is a 4-bedroom, 2-bath. I especially wanted to show this one. These rehabs in Birmingham that REO Reseller does are all pretty consistent with regards to flooring and paint. If I put 5 different rehab jobs on this screen, they all almost look just like that. They buy essentially the same flooring and paint and whatnot. A little bit bigger home, selling at $52,900, which is going to give you a rate of return of about 15%. And E-appraisal says it's worth 76, and Zillow says 66. So, and you're buying it at 52. So you're buying that well below market value, and you're getting a cash flow of about 14%. It gives you a couple examples. Now, last thing, then we'll take some questions. I get asked all the time, what if I get something that's really under market value, and I don't want to hold it for a long term, but I don't want to just flip it right away. I want to hold it for a little while. I call it sort of a hybrid between a buy and flip and a buy and hold. Those are up there, but I get those like once every 10 days. I get something that's really super rare. You have to be on our email list to get those. You have to say, Charlie, I'd be interested in one of those. If you get something that has a really high value, that I can turn it and flip it in, say, 12 to 18 months and take some cash flow, take advantage of the tax benefits, and then sell it at a nice profit. I don't even advertise those. I just kind of throw them up on the screen. This is sort of one. This is one that's going to go for $49,900. You can see Zillow's got it at 61, Truly at 68. Again, Truly average or homes similar like this sold or selling for 71, and E-appraisal's got it at 68, and that's being sold at 49. That's a 3-bedroom, 1-bath. That gives you a pretty good idea. Cash on cash, and that's about at 49 is about 13.5, 14%. So that's it. I'm going to take some questions now. I want to thank everyone for being here today. We've got another one today at 2 o'clock. I have one next week with Brian Davis with Accuplan. I have one the following week with Lamar Baxter with Accuplan San Francisco. We're now part of their family. Going to be working with their investment community. They're folks looking to do some things with their 401k or self-directed IRA. That'll be the following week, so be on the lookout for those webinars. I'll do the top 10 reasons to buy top 10 benefits of buying real estate from a cash flow perspective. I will be doing that probably sometime next week, I think. So be on the lookout for that invite as well. And with that, we'll take questions. I did videotape, so this is being recorded, so I can send that out to folks. And with that, just put it on hold for a second and take some questions. Yeah. Okay, first question. Okay, so I'm not clear. How you gain in this? Where is your fee? Okay, all those prices that I quoted, our fee is in all those prices. We don't charge. I should have mentioned that too, darn it. This is all a typical escrow transaction. So everything we do goes through an escrow company, either Fernley McDonald and or Jeff Palmer, who's an attorney down in Birmingham, does a lot of closings with hedge funds. We now work with him as well. Our fees are into those prices. So you're not going to get, hey, you got to pay Charlie or you got to pay, the escrow agent. All those fees that I quoted are built in. And generally, when I work with another wholesaler, I generally will tell them whatever your cost is to me. In other words, if an investor is going to buy something from you, you have to include all the fees in there. There's no closing costs. There's no fees to a broker. None of that stuff. So the fees are factored into that, into those buy and holds. You mentioned many people buy in an IRA. Don't you lose many of the tax advantages using that vehicle if you if you have a buy and hold mentality? Seems to make more sense on a flip. Well, there's tax benefits in a buy and hold. I just don't know. I'm not going to try to quote them because I would screw that up, so I'm not going to do that. In a buy and flip, there are some tax benefits. There's also some tax ramifications. Remember something: if you buy something in a buy and flip, if you make profit on that flip, you're going to pay taxes on that. There'll be a tax event there. So you want to talk to your tax preparer about that. How do you do it? A lot of people that do flips with us is they just go right back in again. So they're not. It's called a 431 exchange, and what it means essentially just that you bought a property for X, you sold it for Y, you made $5 grand. You take that $5 grand and you invest it again in another property. You don't have a tax event. So there are some tax benefits to that. There's lots of tax benefits to a buy and hold. I would encourage you to attend the webinar. We'll talk about that in detail on that webinar. Okay, you speak of leverage. Does this mean IRA accounts are not eligible? Also, if a non-IRA buyer, do you arrange bank financing? Okay, we don't do any bank financing at all, and we've talked about that, and here's the reason why. I just have not met any sort of non-recourse lender that I think brings value to the party. Most of these lenders, they want fees up front. Let's say you're buying a $50,000 house. It's going to cash flow you $6,000 a year in free cash flow, or thereabouts, a little more than that actually, but anyway, you're going to pay at least a $5,000 fee to a lender, so you're going to give away most of your first year's profits by just paying the fees for a loan. So I don't work with any non-recourse lenders, frankly. If you're looking to do bank financing, that's different. If you want to go to your bank and get a loan to buy a property or two, that's not a horrible strategy, especially if you've got solid credit. You can get it at a decent price or decent interest rate. That's not a bad strategy. As we talked about in the top 10 reasons, that's what that leverage thing is all about. You've got your tenant paying your mortgage for you. So you've got a piece of property, the tenant's paying your mortgage for you, the property's going to go up in value, you're going to sell it in 5 years, you bought it at 50, you're selling it at 75. It's a nice way to pad your retirement account. And that's all the questions I see. So with that, I'll say thank you for being on today's webinar. We have another one today at 2 o'clock. And if you've got questions, I left my number up here on the screen for a little bit. You're certainly more than welcome to give me a shout. I'm here all day today. I always make myself available on the days of webinars so I can take people's phone calls. So if you have questions, you can feel free to call me. There's one more question. Buy and hold 5 years later, I sell and share the profits with you, 50-50. Is rent also 50-50? Question. No, on a buy and hold, 100% of the profit is yours. We don't keep any of we have what we call a JV agreement on a buy and flip. On the buy and flip, what REO Reseller does is they do share the profit with you, but they do all the work. So it's like you're buying it wholesale, they rehab it, they get it rented out until it's sold, and then they share the profits 50-50. That's on a buy and flip. If you're interested in a buy and flip, call me and I'll give you detail. But on a buy and hold, the answer is no. 100% of that money is yours. So having said that, I want to thank everybody for being here. Great questions today. Again, I'll leave my number up here if you'd like to chat with me. You can give me a shout. And thanks, everybody, and we'll hope to talk to you soon.